You know, Ryan,
Good morning, sir.
you waiting for my speaker to get on. He's working on it. Because millions of trust is in oh no, is it? It's like if you get on property assessing or whatever, you'll be like, oh, Matt. Oh, you know, trust. Okay, but you don't. My name. So your first, yeah, it's not just so there. Yeah, or some, yeah, you can have it. Right. Well, hey Roger, how are you?
Hey guys, how's it going?
Good, good.
That is not good lighting.
Good, good. We got a few online, we got a few here. Scott's sick. I think a lot of people fell, so I'm recording it also. I know you're recording it. We've got several people that want the recording, but I'm just gonna hand you the floor. This is Roger. He is a tax mediation, helps his clients, kind of like Scott and I do, think outside the box with your taxes, with your optimizing their income and just long-term financial success. So I'll turn it over to you, Roger.
Awesome. Well, appreciate the opportunity. So is Scott here as well, or is it just Matt?
It's just that Scott got sick on the way up here. Like I said, I had a couple of them calls this morning. People were down sick, so he was actually on the way and I had to pull over. So
All right, no worries. Well, so I'm gonna treat this like a Zoom call. Looks like there's a few people on, so I'm gonna talk high level. But it's a pleasure. My opportunity to work with Scott and Matt has been something I'm looking forward to because these are good guys, and I've just um, found in my life that the more I can be of value to people who really have the right objective in mind is to me what drives me at this point in my life. So, can you hear me all right, Matt? Does it sound pretty good? Okay.
good, yeah, we got to speak. Yeah,
So I don't know who on this call has seen or heard or know much about me. So I'm just going to start from the beginning, talk a little bit high level about what we do, and then actually dive deeper into some case scenarios. Okay. So again, I'm Roger Roundy, the CEO and owner of Strategic Associates, which is an advanced tax mitigation consulting firm. What that means is we are tax planners. So, um, we've been doing this for, I don't know, 15 years now. And our role is not to replace anybody on your current financial team. So we're not trying to be your financial advisor. We're not trying to be your tax preparer or your CPA or your tax attorneys. What we are a resource to help you accomplish the task of reducing your taxable income and saving money in taxes. Okay. Now, a little bit about me is that, I live in Logan, Utah. I love our country. I think we live in the greatest place on earth. I have a wife and 5 kids. I fly a flag out front of my house, and I believe that as citizens of the United States, we should all pay as much in taxes as we're obligated to, but not a penny more. So I have found that there's a need, especially in the mid-size income level, where you're not an Elon Musk or a Donald Trump who has teams of guys like me on their payroll, but you have a CPA who is really good at preparing taxes and maybe not quite as good as planning for the tax liability that's to come. So we are focused on working with your CPA, with your financial advisor to make sure that by the end of the year, when you all of a sudden realize, hey, we had a great year, we're going to plan for the tax bill and see if there's ways in which we can implement strategy to reduce the liability for that year. Tax planning happens all year long. Obviously, the fourth quarter, when you finally know how much you're going to make, that's when and that you're going to mitigate your taxes. Then you can also plan ahead for the cash flow. You not need to make those quarterly payments because you know you're not going to need to make them anyway because you're going to mitigate your taxes. So that's what we do, and we have a team of planners. I've got now 6 or 7 guys on my team who will meet with the client and determine what their taxable income is. So what we're going to want to know is what type of income that you're making, how much it is, how it's going to be taxed. Once we know what your tax liability is, then depending on the type of income and how it's being taxed, we're going to suggest 1, 2, or 3 different strategies to help you reduce that tax liability. Okay. So when we come into play is when you're expecting to pay $75,000 to $100,000 in taxes. That's when you say, you know what, that's getting to be a little bit much. We should really talk to Roger and his team and see if there's anything we should be doing that would help us reduce that tax liability. So that's the overall big picture. Is just understanding that there's reasons why the elite and the Fortune 500 don't seem to pay as much in taxes as everyone thinks they should. And that's not because they're tax evaders. It's because they literally have guys like us on their payroll to help them implement all of the different strategies or incentives that are in the tax code. And that's important. I'm just going to do a little tax 101, Matt, just to make sure, because I don't know who's seeing this, who understands. So just a little bit of tax 101. Whenever Congress sees a problem, they try to create an incentive to fix that problem. Okay. That incentive ends up being some form of tax code that says, hey, Matt, if you'll do this, we're going to allow you to deduct this from your tax liability. Right. So we need more housing. So we're gonna create incentives behind building real estate so that's why there's real estate tax incentives. We want more people to be charitable. So we're going to incentivize people to, if they'll give money away, we're going to allow them to deduct that amount of money from their taxable income. So there's a lot. I mean, there's 77,000 pages of tax code. Nobody knows all the codes. Nobody knows all the rules. Our job is to go out and find the strategies and the incentives that have been created and then help our clients who may not have someone in the White House that knows all the tax codes and knows how to mitigate their taxes. We're going to come in and teach you ways in which you can accomplish that task of utilizing the incentives that are there, because why shouldn't a successful small business owner who maybe just sold his practice or sold his business, why shouldn't he be able to mitigate his taxes the same way the elite and the Fortune 500 do it? It's all about education and access, and that's what our firm provides. Okay. So there are 4 different ways in which, or 4 different categories, I'm going to call them, of tax mitigation solutions. Okay. The first is business deductions. So if you're a business owner, you understand business deductions. Buy more stuff for your business, you get to write it off. 162 is the most common tax code that allows business owners to buy more stuff and write it off, right? That's the CPAs love that one. Buy more stuff, spend more money, and you get to write it off. If you need the equipment, buy the equipment, right? But don't just go buy another truck or buy another skid steer just because you want a tax deduction, right? Spending money to save money in taxes isn't necessarily the best tax strategy, but it's the most common. But there are appropriately designed programs that do allow you to protect your risk and mitigate your taxes. So first category, business deductions. 831B private reinsurance is probably my favorite in that structure, in the right scenario for business owners who have high gross revenues and have a lot of risk. Okay. The next category, it's probably my favorite category, which is business ownership with tax benefits, where we're going to start a new business, and this new business that you own is going to benefit from incentives in the code. So in the first year, you're able to receive tax benefits for creating this new business, and that negative K1 that's generated from that new business is going to offset other income, right? So the strategic ownership program is probably the most powerful structure. I know Matt had mentioned someone on the call potentially maybe selling their business, right? That's the structure that most likely would be using if you're selling your business or you have a larger income. That is going to be a larger scenario where if you have over 800,000 of ordinary income or over $1 million of capital gains, that's when we'd use the structured ownership program. If you're making less than that, but still have a fairly decent tax liability, there's other business ownership strategies where maybe you're starting a new solar company or a new equipment leasing company or a new real estate company. So there's different benefits for business ownership. And again, depending on the type of income and how much it is, business ownership can be a very beneficial tax situation for you. Those first two categories are above the line, meaning if back to tax 101, all of your different income types, your W-2s, your 1099s, your K1s, your long-term capital gains, all income that you make in a year, it all flows down to your personal tax return. And that income establishes what we call your adjusted gross income, your AGI. Most of you have heard that term, adjusted gross income. And again, I don't mean to talk down, I'm just trying to keep it at least high level so everybody's on the same page. But once you have established what your adjusted gross income is, then you're going to have deductions that are above that line, and then you're going to have deductions that are below that line. The below the line deductions is the third category, the personal deductions. The largest category in that area is going to be your personal deductions. And I like the category of, we call it leveraged charitable gifting or volume discount charitable gifting. With that strategy, most of you have given money away. You've given money to your church, you've given money to Red Cross, you've given money to Boy Scouts of America. Wherever you've given money, you know that when you give $10,000 to your church, you get a $10,000 deduction, right? Well, that's a 1-to-1, 10,000 in, $10,000 deduction. Well, what we have are 3 or 4 programs that allow you to use the power of leverage or a volume discount to increase the power of that donation dollar. So instead of getting a 1-to-1, you're getting a 1-to-5 or a 1-to-6 or even a 1-to-8. You're putting in $50,000 and you're getting a $250,000 reduction of your taxable income through a charitable gift that you're going to make. For high W-2s, that's a very, very powerful structure. Also, when you have a large qualified plan or a large 401k that you're trying to pull money out of, that's a really good strategy for that type of income. Works for all incomes, but that's where we use it a lot, is in the high W-2s or the qualified plan distributions. The third category, or the fourth category, I call tax credits or convertible tax bonds, where a tax credit is different than a deduction. If you're not quite understanding the difference between a deduction and a credit, a deduction, if I get a $200,000 deduction for giving money away, that reduces my taxable income. So my AGI goes from $500,000 to $300,000 because I had a $2,000 deduction. A tax credit is an actual amount of money it's a 1-to-1 benefit, reducing my tax liability. So if I was making $300,000 and my liability was $100,000 and I had a tax credit of $100,000, that would wipe out my $100,000 liability. So credits are a 1-to-1 reduction of liability deductions are reducing my taxable income, which then establishes my tax liability. Okay. So there's a couple different programs in there. So again, every situation is different. And that's what I love about what we do in our firm. Okay. Because I'm not a one-trick pony. I'm not just slinging one strategy and I'm out there just trying to sell you a bunch of whatever it is. Right. Our process is pretty simple. When your income is in the $350,000 to $400,000 range, that's when the resulting tax liability is most likely going to be above that $75,000 to $100,000 threshold. That's when we come into play. If your income's less than that, we have a list of 12 ideas. Matt has it. You can just go look for it. And here's the things you should take a look at. That's not where we come into play. And what we come into play is when that income is at that level where, hey, I really don't want to fund society. Now, I believe that we should all contribute to society. Okay, there's a difference. Me paying $30,000 in taxes is me contributing to society. Me paying $200,000 in taxes is me funding society. See the difference? So what we're trying to do is accomplish the task of participating, because we all live here, we all drive on the same roads, our kids go to school. We have to fund society. We have to contribute to society, but each one of us individually should not be funding society. Matt doesn't drive on the roads any more than I do, right? Why should he pay more taxes than I do? Especially if there's appropriately designed strategies to help him utilize those incentives in the tax code to reduce that taxable income and participate in the programs that are out there. Our job is to provide the access. So our process is this. What I'd like to know is basically bring me your income. What type of income are you making? Are you a business owner and you have a K-1? Are you a consultant and you're getting a 1099? Those are both business incomes. Right? Or are you just a high W-2? You're an employee, but you're making a lot of money? Or are you about to sell your business for a couple $1,000,000 and you don't want to have to give 25 to 30% of that to Uncle Sam to control, right? So once you know what types of income you have, that's where we're going to sit down and we're going to say, okay, based on this type of income, we should take a look at this strategy, or this strategy. We will educate you on that strategy. You get to pick which one you like. You say, Roger, I like that one. Let's do it. Okay, great. Our team, I've got in Logan, Utah, I've got 25 employees that are on my processing team, right? So we're going to gather all the data. And then we provide that data to the particular program or strategy that we feel is going to be best you decide to go with. We help implement it. We help make sure everything goes through. Once it's done, whatever strategy it is, we're going to provide the appropriate documentation to turn over to your tax preparer, right? Now, there's two types of taxpayers in the world. There's those who tell their CPA what they've done, and there's those who ask their CPA for permission. What I mean by that is a lot of times you don't know this stuff. You just go work, you do your thing, right? I know how to swing a hammer and I do a really good job at it and make a bunch of money doing it. Great. I don't expect you to be a tax professional. You may have a tax preparer on your team. And if you'd like us to educate your tax preparer, 90% of my time is spent teaching financial advisors, CPAs, tax attorneys on these structures, right? So that's what we'll do is find out if you have a problem that fits our parameters, teach you a couple different strategies, and you say, hey, this is great. I need you to sell my CPA. No problem. Let's get the CPA on the call. We'll educate the CPA, make sure he understands what we're trying to help you accomplish, answer all those questions, and then we take it from there. So first thing we're going to always do is you come to us, especially this time of year, prior to fourth quarter or during fourth quarter, we're always going to try to take a look at the spilt milk. What do I mean by spilt milk? Well, we do have programs where we can go backwards. We can take a look at 24, 23, 22. Was there a year where you did sell your business and now you think it's too late? Well, it's not too late. There's actually programs that we can use to go back and recapture some of that spilt milk. Right? Now, those programs, there's a lot less of them, but there are ways in which we can help you reduce your taxable income from prior years, recapture some of those overpaid tax dollars. Those programs, there's only a couple, but they're worth taking a look at. Right? But Matt, if you could turn $75,000 into $100,000, how many times would you want to do it?
every time.
It's the wrong answer. Okay. The right answer is as many times as I could. Okay. Teasing, but that is the case, right? And the as many times as we could, or our limiting reagent is if there's a year where backwards, you take a look at 24, 23, and 22. Were there years where you had over $100,000 of liability that we could go back and turn 75 grand into 100 grand? That's the most common, simple way to go backwards. Okay. If you're still in extension, okay, and I know we're getting close to the end of extensions. October 15th is arriving quickly. Some of you business owners are like me and you're just barely getting to it. So if you're still in extension, we can actually add it to your 24 return file right away, and that return on investment of 75,000 to turn into 100,000, we can add to your return, and that return happens in 45 to 60 days. So if you're still in extension, you have a large tax liability, we definitely want to talk sooner than later. Okay, meaning now. So once we clean up the spilt milk, okay, once we've looked at your prior years, we've talked about the situations, and you're like, okay, I'm done with that. We don't want to spill the milk again. Okay. What that means is we need to do a plan in 25 for 25. Tax planning doesn't happen in April when you're doing your taxes. Tax planning happens in the year you're making the money. So, especially for the next 3 months, is tax planning season for us. That's when we take a look at your income. We look to see, hey, is there going to be a tax problem this year? Yes. Okay. What type of income is it? When's it going to hit? What's our situation? And then that's when we really dive in and take a look at what things we should be doing now, because it's a lot easier to mitigate your taxes in the current year than the prior year. We'll implement the strategy, help you get all that documentation in place, and accomplish the task of reducing your income. So, Matt, I don't know who all is on this call or what type of income. I thought it might be helpful to just maybe walk through some numbers on a couple of the strategies, just to because I know there's a lot of people are going to watch this recording and so forth, and so.
That'd be great if we do that.
So we have a little bit of time. So I'm going to just kind of walk through how we normally do things. I'm going to talk numbers, and I somewhat get reserved doing this. It's on a Zoom call because they're going to say, well, how in the world could you do that? And I'm not going to dive through the whole intricacy of the strategy, but what we usually do, and I'm going to go ahead and share my screen now, and we're just going to walk through a couple of the high level dollar amount structures so you can see the power of what we can accomplish together. So what I'm going to do is let's just start with this one. Okay. Are you seeing my screen at this point?
There it is. Yep.
All right. Does that look okay?
Yeah.
Yeah. All right. So every time we meet, once we've gotten to know each other and I kind of know what your income type is, where I'm going to look for are 5 data points. So every time that, regardless of the type of income or how much it is, we're always going to want to know these 5 things. Okay. First thing we want to know is your filing status. Are you single or are you married? Are you filing jointly? Are you filing separately? Let's just pretend you're married filing jointly. And I know you guys are in Tennessee, right?
Saying,
Yeah. Tennessee makes me a little less cool, just so you know, because you don't have state tax. So not as big of a tax. So you've already mitigated your taxes just by moving to a good state, right? Which I do love the state of Tennessee. But once we know what your filing status is, what state you're in, then we're going to want to know three numbers. And these numbers are your taxable numbers. Okay. What I mean by that is I want to know your taxable business income. After you've done all your other little dinky deductions, writing off your miles and your home and the little things that you've always done, what's left over? What's still going to be taxable to you? Okay. So let's just assume that number is $300,000. Okay. And so that's what you make in your K1, but then you pay yourself a wage. Most business owners, they have their K1s and they also have their W-2. And let's just pretend that your W-2 is $250,000 or $200,000. Okay. So we're going to want to know any W-2 earnings or any IRA or 401k distributions. Those can be in the same category. So business income, which would be 1099 or K1. W-2 income, which would be your W-2 or any qualified plan distributions. The third number is going to be your long-term capital gain. Let's just, for this scenario, I'm just going to say you didn't sell your business this year. Okay. Well, you'll see if we have 300 of business income, 200 of W-2 income, my AGI is now not adding appropriately, so we're going to go like this. There we go. Okay. So my AGI is $500,000. Okay. Well, if you're making $500,000 or your AGI is $500,000, then your tax liability in the state of Tennessee is going to be $114,000. What can we do to mitigate the tax liability on that $14,000? Well, one way is to do charitable gifting. This particular structure is going to, every time we look at any of these programs, we're always going to look at this red line is always going to be the required capital outlay. The required capital outlay in this scenario would be $66,000. That $66,000 is going to create a reduction of your taxable income by $297,000. That $297,000, I apologize, I must have been playing around with my pro forma here, so bear with me 1 second. There we go. Is going to reduce my AGI from 500 down to 198 because I was able to get a deduction of 300 grand for my $666,000 charitable contribution. So now my taxes went from 114,000 down to only 33,000. It cost me $66,000. So my net benefit would be I saved $13,000 for that $16,000 deduction. Now that is a 20% ROI. Okay. So in this scenario, because you're in Tennessee, this may not be the scenario we use. Okay, this was a good practice because unless your ROI is over 33%, we wouldn't use this strategy because we could use a different strategy that would always be something a little more powerful. Than anytime we want to work together, our goal is to always make at least 33% return on investment. So this wouldn't be the scenario we would use for that. This wouldn't be the program we use for that scenario. So again, we're going to meet with you and determine when we can get to this number of over 33%, right? But let me teach you how that program actually works and when it would make sense. So charitable gifting in this scenario, we call it volume discount purchasing. Okay, what that means is instead of getting a 1-to-1, I'm getting a 1-to-5. And the way we accomplish that is that every year we work with a different program. This year, the product or the solution that we're using to give away is it's charitable gifting is a medical device. Okay, this medical device uses sine wave technology and infrared lighting to speed up the healing of injuries. It's called DNA Vibe. Well, that product is $300 on Amazon. What we're doing is we're going to be buying the manufacturing rights of about $100 million worth of this product. Matt, when you buy $100 million of something, you get a pretty hefty discount, as you can imagine. Same reason you go to Costco or Walmart or Sam's Club is because when you buy in bulk, you get a volume discount, right? So that's the concept of volume discount purchasing. So you're going to be participating in the volume purchase of this medical device, and then we're going to turn around and donate the manufacturing rights to that device. That allows us to take the wholesale price, we buy it at the wholesale price, and then we donate it at the retail price. That's what gives us that multiplier effect. In this scenario, $66,000, or sorry, $80,000 would create a $594,000 deduction. Okay. So volume discount purchasing is a very common strategy when your income is below $800,000.
What if somebody had a charity that they wanted to give to, or when I say charity, what if they had a foundation or something like that? Would that still work for this, or is it just?
We would have to account for that, like if they're paying tithing for their church or whatever, we would account for their other charitable gifting and reduce that amount. I don't have a strategy, and that's been a very common question is, hey, can I create a leverage and give it to whatever charity of my choice, right? I don't have one that actually allows us to do that yet. It's something that we've been working on, creating one where we could actually pick the charity. The program or the promoters we work with, they pick the product, they pick the charity, right? So at least on the front end. Now there is one, in fact, maybe we should go there just since you brought it up. It is called, so you can see here, I have all of these different strategies, right? So depending on the type of income and how much it is and where you live, then we're going to implement that strategy. This strategy, in Tennessee, let's pretend that you have a $300,000 business income. You have a $200,000 W-2, but you got a bunch of money that you have sitting in a qualified plan or a retirement account, an IRA. Okay. And you want to start tapping into that IRA, but you know it has golden handcuffs on it, right? It's got handcuffs because when you pull the money out of your retirement plan, you're going to have to pay taxes on that money to get it out and use it, right? Well, Matt and Scott are really good at helping clients take money that has the handcuffs and putting it elsewhere where that can be growing tax-free, right? So, but let's pretend we start a strategy where we're starting to pull money out of our 401k and we start pulling $200,000 a year. So now our income is higher that year. Let's just say we're at $500,000 between your W-2 and you're pulling $300,000 to $400,000 out of your 401k to put that elsewhere where it can grow tax-free. Okay. And Scott and Matt can teach you all about that type of stuff. And now our AGI is up to $800,000. Well, if that's the case, another strategy, and this one does allow us to, at the end of life, give the money to whoever we want. And this strategy is a little more powerful. Anything that you do with us, I kind of see as a trend. The more complicated a structure, the more powerful it ends up being. When I say powerful, it just means the amount of capital required for the amount of benefit that you're getting. Okay. This structure, close all capital, does allow us to borrow money to give away. It sounds interesting. And that money that we end up giving away at the end of life you do get to pick what charity that money goes to. This scenario has a lot higher ratio, or it's a bigger multiplier effect. For example, with charitable gifting, we're going to look at your AGI. And the law only allows us to write off or reduce our AGI by a certain percentage. It's either 30, 50, or 60%, depending on the type of donation you're making. If you're donating a product, it's 30%. There's certain products that do allow us to go up to 50%. If you're donating cash, you can reduce your AGI by 60% of your AGI. Well, if we're at 800,000 of AGI, 60% of that is $480,000. Well, with this particular structure, you can either give 480,000 of your own money away, or you can give 480,000 of somebody else's money away. This particular structure is one we use a lot with people who understand the power of planning, like Scott, Matt do, with permanent life insurance and if you're planning and estate planning. You incorporate all of that into your actual planning. This one actually becomes a very powerful structure, because as you can see, we're only going to have to put in $64,000 for a $480,000 deduction. That's more like a 1 to 8. Well, if I put in $64,000, I get a $480,000 deduction. My new taxable income is $320 instead of $800. Now my liability is not $220, it's only $62,000. Well, in this scenario, we're reducing our tax liability by 157 grand. It went from 220 down to 62, which is $157,000 deduction, a reduction of tax liability. The amount of capital required to do that was only 64,000. So we're net ahead $92,000. That's $142,000 or 142% ROI. You took 64 grand, you turned it into 92,000. You can see that structure is going to be a lot more powerful. The nice thing about what Matt just said is the initial donation that this one's making is going to go to not a charity of your choice. But at the end of your life, that money then gets transferred to the charity of your choice. Again, I don't want to dive into the actual structures right now. I'm just trying to show you, hey, there's different things that we want to walk through depending on what your goals are as far as reducing your tax liability. And if you have certain things that you like, as far as charitable gifting, or if there's other programs that we're going to show you, you get to choose. Okay. And most of the time, what we're trying to accomplish is making this number, your net cash flow increase and the rate of return, always more than 33%, sometimes substantially more. Okay. So charitable gifting is a very powerful solution. Problem with charitable gifting is it is capped, right? You can only reduce that $800,000 by $480,000. It's still leaving 62 grand, which is still a good deal. There's other structures we can do that even would be more powerful, and depending on the type of income, that's what we're going to suggest. So because I know there is someone who was watching who was going to sell their business, I want to talk about the SOP structure. It's actually the one I use for my own tax planning. I feel it's very beneficial and powerful, and it works really well. It's by far my best long-term capital gain strategy. So you do have a long-term capital gain. It's one that I would definitely consider. So let's go back to 300,000 of business income, 200 of W-2, and you sold your business. And let's just say, do you know any numbers, Matt, is there a particular case you want me to throw out?
No, I don't know the numbers, but.
Okay. All right. I'm just gonna,
Go through your numbers.
let's just say you sold your business for $3 million. Okay. Well, if you're at $3 million on your long-term capital gain, you make your 500,000 that you normally make. Well, now your tax liability is $714,000 because your AGI was 3.5. I would submit that $314,000 is starting to get up to that threshold of funding society, right? What I would show you is that we can create a new business, and this is a business owner structure. We can use it for both ordinary income, your business income, or a long-term capital gain, or both. So depending on what's going on. But let's just pretend you have a $3 million capital gain that you'd like to not have to pay the taxes on, or find a way to mitigate the taxes on that 3 million bucks. Well, what I would be showing you is an SOP structure. That SOP, what we can do is we can create through a new business program where you're starting a new business, and that first year, that new business is going to have a $3 million negative K1 to offset $3 million of your long-term capital gain. If you have a $3 million negative to offset $3 million of positive, the tax liability is now zero on that amount. Okay. The dollar amount to accomplish that task, again, that red line, is $450,000. So we're going to take $450,000 of the $3 million you received. We're going to put it into an SOP structure, and that 450 is going to create a $3 million negative. It's going to wipe out 3 million of your $3.5 million AGI. You'll be left with $500,000 of taxable income. So now you're paying 114 instead of 714 in taxes. Now it's going to take you 450 to do that. So combined, you're paying 564 taxes and products or tax planning, and you've taken 300 because 300. So we go back to the green box. The green box is always our box that's going to tell us our benefit. In this scenario, we've reduced your tax liability by 600 grand. We're going to pay 714. Now you're only paying 114. So you've reduced your tax liability by $600,000. The actual cost to do this structure, the capital is 450, but the actual cost is only 300 because 150 of this 450 is actually going to be sitting in your business still, and it's still going to be kicking off an annual rate of return. So if the total actual cost is only 300 to mitigate 600, that means you're net ahead $300,000, and that's 100% rate of return. You've taken $300,000 to reduce your tax liability by 600,000, so you're net ahead 300 grand. Okay. And you have $150,000 sitting in an investment account that you get to decide where you want to put that to work. Okay. That investment account, let's just say it's making 10, there is a 4% expense cost of 6, so you're net ahead $9,000 every year for the rest of your life. This is the structure that if you have a larger income or you do have a capital gain, this is one we'll be talking about. Okay. But again, every situation. Go ahead, Matt.
Here you go.
Did you have some?
Yes, how would you get access back to the 3 million that was sold?
Sorry, say that again. You're not quite loud enough.
Like, he's talking about the 3 million he sold the company for. How does he have access to that? Like,
So that's the beauty of this particular structure, right? Your $3 million is sitting in your bank account when you get it from whoever bought your company, right? It's sitting there in your account. We're only going to take 450 of the 3 million. The rest, the other 2.55, is still sitting in your bank account.
okay.
So
That's
you're,
the power. That's the
you're
power.
saying $3 million is what you're buying in at the lower rate.
Say that again.
3 million, is that what you're selling the business for?
Yeah, you sold your business for 3 million. So you got that deposit into your checking account, right? Of that 3 million, we're gonna take 450 and apply it to an SOP structure. Yeah, that's all we're taking.
So you
The other
still,
2.5 is after tax dollars sitting still in your bank account. We're not taking any
I was
money.
looking at it the wrong way, because I think if you were starting another company, that means you have to have some type of business in order to recruit that investment.
So this other business we're creating is going to be a little asset management firm or a little investment company.
That's, you didn't mention that, that's why I was missing that piece of the puzzle. Okay,
and you're just investing.
right, so it's an investment company then, at that point.
You're starting a little investment company with 450 grand. Okay.
That, that makes perfect sense now, okay.
Yep. And in year one, that little investment company is going to have more expenses than revenue.
Correct.
You're going to create $3 million of expenses in that little business. And we're going to take that $3 million expense allocation to create a negative K1 that'll then flow down to your personal tax return. That negative K1 is going to offset 3 million of your positive income. So in year one, we're creating an offset with that new little business that we created. If your situation is this, you have over 800,000 of ordinary income or over $1 million of capital gain, or both. That's when we use an SOP structure, right? If that is the case, then we get on a call and I'll walk through the entire structure step by step, explaining exactly what this $450,000 is doing to create a $3 million negative K1. But if you want to go super high level, this is a lot like if you were to take $450,000 and go start a car wash. In year one, you're going to have the money you put into the car wash and you're going to take a bunch of debt because it's going to cost you $7 million to build this car wash. Right. Well, in year one, you're going to be able to write off all the expenses. So it's going to create a loss, right? Because you have more expenses than revenue that year. That's what we're doing in this structure, is creating a situation where you're going to have more expenses than revenue in year one. And then for the rest of the life of the structure, you're going to have a little positive income because now you're washing cars and you're starting to make a revenue, right? So that's high level. That's how this one works, is utilizing the power of leverage to increase your tax benefits.
Could this company also be structured within a trust?
Absolutely. Yep. Yep. Mine's owned by my trust. So this is actually the one that I use myself for my own tax planning and have for 4 years. Right. So my trust owns this little business. The tax benefit flows down to me personally, and I use it to offset my ordinary income every year.
That makes perfect sense now.
I wouldn't say perfect sense because I haven't walked through the whole thing, but that's the high level. That's what it does. Okay. So you'll understand it. My goal is to always make sure, and I don't expect my clients to be tax professionals and understand everything I say. But here's just to kind of wrap up the meeting today, Matt. Just philosophically, I want people to understand who I am and what I do, right? Somehow, and I've known Matt and Scott for a long time. So if you know them, at least they've known me for a while now and I've been around, and my goal is to do good and be good. But somehow over a computer screen, I have to convince you that I know what I'm doing and that I'm not going to try to bamboozle you. Okay. The only way I can do that is just tell my story. All right. If I'm at my home office, I'm going to show you the view out my window and let you know where I am, and that my whole goal is to help you find those solutions and strategies that personally I've vetted out to make sure that the programs are legitimate, right? Because in my space, there's not a lot of tax planners out there, right? There's very few, actually. Most CPAs say they're their tax planner, but then I talk to them and they're like, I say, hey, how is your CPA? He's great. Well, how much did you pay in taxes? Well, I only paid 200 grand this year. He got me down from 300. Okay, but you still paid 150 too much, right? So The way I accomplish that is vetting out structures that are out there. There are lots of different programs. Okay, lots of them. And every week I'm introduced to a new structure or strategy. Our process at Strategic Associates is my job is to make sure that if I'm promoting a particular structure or strategy, that it's legitimate. Because in my space, there are some shysters, those out there who are just trying to make a buck. They don't even understand taxes. They just see a way they can make money and they just start slinging a strategy, right? That's not how I do business. My job is to vet out a structure, add it to my suite of options, and not try to cram one solution down anybody's throat, but I want to give you options. But what we do is when I'm introduced to a new structure or strategy, first thing I'll do is I'll look at it. Now, I've seen these for 15 years. I've seen a lot of different ways in which people have figured out how to mitigate their taxes. Once I understand high level what's happening, then I'm going to turn that over to my smart team. My smart team are the guys who read the tax code, enjoy reading the tax code, right? These are the resident geeks that you need to have on your team to make sure that structures are real well designed. So the smart team, they're gonna dissect the strategy. They're gonna take a look at it for relevancy, make sure it's within the intent and confines of the tax code they're using. And once they've dissected it, tore it apart, put it back together, only then would we add it to our suite of options after I go through the last test, which is whoever's promoting this particular structure, is it someone that I like? I don't need more programs. I got lots of structures and strategies. I just want to work with good people who I know have the right intentions. But once they've been through our vetting process, then I'll add their program to my suite of options. Okay. Then we meet with the client. We sit down with them, determine how much income it is, what type it is. Once we've diagnosed the problem, then we're going to say, hey, here is option A, B, or C. Which one do you like the best? Okay. Our warranty is that if we help you mitigate your taxes, that means that we got paid to do so. Right? Now, we don't charge consulting fees. Okay, you don't have to pay me just to talk to me. That's never been my MO, right? A lot of the guys in my space will charge a consulting fee, 5, 10, 20 grand just to talk to them. That's not how I do business. You sit down with a member of our team, we're going to analyze your situation, we're going to give suggestions. If you implement a suggestion, that's when we get paid by the program administrators, just like a life insurance agent would. You buy a life insurance policy, the agent gets paid by the carrier. If you don't know how that works, that's just the way the world works, right? We get paid from the promoter. I don't charge a consulting fee. Okay. But because I get paid, I feel an obligation to make sure that if you implement a structure to reduce your taxable income, that I'm there to support if in fact you get audited. Okay, so here's the audit question. Will this get me audited? I can't tell you if you're going to get audited or not. I don't control the IRS. What I can say is if you implement a structure with my firm, you're going to have 100% audit support. What I mean by that is typically, and if you've never been through an audit, basically the first thing that's going to happen is you do your taxes and then a year or two later, you get a letter from the IRS saying, hey, tell us about this particular deduction. You would send that letter to us. We would then send it on to the audit defense team. Any structure that you do with my firm, I require that the promoter of the actual strategy offers audit defense at no cost to me and no cost to my client, right? To me, that's super important. My reputation is very valuable to me because I can't tell you if you're going to be audited or not. You know, I've been doing this for 15 years. I still have 0 audits, but that doesn't mean you couldn't be audited. It's just we have a very good track record. But if you are audited, just know that we would be there to support the audit and we would have a defense team there to defend the audit, right? Most of the time, what would happen is the auditor would talk to the attorney who defends the structure. The attorney explains it to the auditor, and we move on, right? My firm itself, we've never had an audit in our firm. We've done thousands of tax plans, still no audits. right? But the most of the programs we work with, they've been through audits of some form, right? And I don't work with a structure if they don't win an audit, right? If they haven't been through an audit and they haven't been able to pass an audit, then I don't know if it's going to be good or not. So I make sure that they have some form of track record. Okay. And if they have had a loss, which sometimes there are, we don't work with them. Okay. So, again, very, very important to know there's always going to be risk in anything we do. It's just how do we mitigate the risk, right? And that's my job, is to make sure that if you do something with us, that you're going to be comfortable enough that we're going to be there to defend and support any audit that happens, if it ever happens. Right? So, Matt, that's my 57 minutes. What more would you like me to finish up with? Is there any questions that you would have or that you think that the people watching this Zoom would have that I can answer?
I think you did a good job. I just want to reiterate too that you don't try and kind of like us, you don't try and steal any business. You like to work with the accountants, the CPAs to make sure, like I said, exactly what you do. Like you don't try and go in there and, yep, I'm gonna do all this for you and get rid of all your people. That's one thing Scott and I don't do, Roger don't do. We work with the people you already have in place. So I just want to say that, but you did a great job. I appreciate you. If anybody's got any questions, just let me know. I had one. Do you have the 12 ideas that you presented?
I'll send you a list. Yep. I created a little list of, just the small strategies that people can implement, the Augusta rule and hiring your kids and all that sort of stuff. So I'll send you that, just so you can have it and send it out to the people who may not be in that higher income but still want to mitigate their taxes. So just to wrap up, our goal is, again, let's keep as much money as you possibly can in your own pocket. But whenever we save money in taxes, that's money that was going to go off to Uncle Sam to control, right? If I keep 100 grand in my life because I didn't send it to Uncle Sam, that $100,000 to me, and not to be sacrilegious, it's sacred money. It's money that you've brought back into your life. But let's be very careful with the tax savings money, right? If we keep 300 grand, and like in this scenario, let's put that $300,000 someplace safe, secure, growing with ancillary benefits, right? And that's where Scott and Matt come into play, right? My job is to help you keep more money. Scott and Matt's job is to help you put that money someplace where it's going to continue to grow, be part of your legacy. So that's why we work so well together, is that I know what your objectives are. We want to help save money, but then put that money in a place where we know that it's going to be there, and it's going to be there for your family. It's going to be there for you. Let's just make sure that if we save money in taxes, that we're being very strategic about where we put that money. And that's where Scott and Matt come into play, is let's save the money, but then put it someplace safe. Let's put it someplace secure. Let's make sure it's growing. Let's make sure it's providing the ancillary benefits that Scott and Matt know how to create with you. So that's how we work together. Appreciate the time, Matt. If anyone does have any questions, Matt and Scott know how to get a hold of me. Just reach out to them. Let's set up an appointment. We'll walk through your specific situation and scenario. We'll design a couple different strategies that'll help you reduce your tax liability. But again, when we come into play is when you're expecting to pay over that $75,000 to $100,000 in tax liability for the year, state and federal combined, if you're in a state that's not Tennessee. And we'll see what we can do to help you out. So,
All right, appreciate you, Robert.
all right. Well, thanks, Matt. Appreciate it.
Have a good day.
Yep. Talk to you soon.